Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's a lot happening in markets. I feel like I've been saying that a lot recently. A lot we're going to cover today. But for me, the headline is, for all the noise, for everything that's happening in markets, the ASX 200's up 1% for the year. The S&P 500's up 0.5% for the year. Seems like it's been a pretty vanilla year.
Make some noise about it, though. Get it on the front page of the papers.
the ASX 200's up 1%.
Yeah.
Wouldn't sell papers.
Where's the recovery headlines?
Wouldn't sell papers like the famous news.com.au headline, "Market bloodbath worst yet to come." Now that sells papers.
No, it should be, have you missed the boat? Or like something that's, anyway, reminiscent of a recovery. But we're going to cover the news today, Ren. We've got a Pimp My Portfolio with Adam Dawes, where a community member submits their portfolio for Adam to give his thoughts. And we're going to close out with a question from a community member as well around the impact that rate cuts will have on investment opportunities and which investments might benefit.
But before we get into it, a reminder that Equity Mates is now on TikTok. We've been on TikTok for a little while, but we're trying to grow our following there. We're trying to be wherever people are, sharing good investing information and getting people excited about the opportunities in markets. So if you are on TikTok, if you want to upgrade your scroll, come and give Equity Mates a follow. Will Bryce and I be lip syncing and dancing? You're gonna have to go over there and find out.
News and markets.
The key stories that we want to cover this morning are the US-China trade tariff de-escalation continues. There are some price wars brewing here in Australia. Xero has had a stunning result. And can someone please turn up the difficulty on investing? It's too easy.
All right, well, let's get into it. Let's start with the US-China de-escalation. Last week we saw that they met in Geneva, the two sides, and agreed to a 90-day reduction. The US reduced tariffs from 145% to 30%. China reduced tariffs from 125% to 10%. So both sides took 115 percentage points off their tariffs. But what we've seen in the days since is that there have been step downs in a number of the other, I guess, like non-tariff trade sanctions between the two countries. So we saw, do you remember the de minimis packages that the packages worth less than $800 where they weren't subject to US tariffs?
Yeah.
Well, Trump closed that loophole and then put 120% tariff on low value packages coming from China. The US has reduced that to 54%. Then we saw China suspend a trade and investment ban it had imposed on US firms who were looking to invest in China. And we also saw China lift its ban on Chinese airlines buying Boeing aircraft.
Good news for Boeing.
So, well, we'll get to Boeing in a second, but some big step down. Well, some reasonable size step downs from both sides.
Yeah. I mean, certainly a de-escalation, that's for sure. Whether or not I'm interested to know what's going on behind closed doors and how they're actually. I think we spoke about it in the last episode. I think really actually working to structural change, which Trump wants for the trade deficit. But 90 days. Here we come.
Yes. Well, let's zoom in on Boeing because that's not the only good news Boeing had last week. Have you been following Trump's trip to the Middle East?
How can you not? It's everywhere.
So he's traveling through the Middle East. I think his goal is to get $1 trillion of investment.
Yeah.
And he's certainly well on his way by the looks of things. Who knows, again, what conversations going on behind
investment.
Closed doors. But one that was relevant for Boeing, the largest wide-bodied plane deal ever was signed when Qatar Airways agreed to buy $96 billion worth of Boeing planes, 210 planes in total. with GE engines.
Yeah.
So
Huge.
Boeing's had some good news. The important thing to remember is that we looked at this a little while ago. Boeing has like an 11-year backlog already.
It's going to take ages.
Yeah. So now China can buy again.
Yeah.
The US-UK trade deal or almost trade deal saw the UK agree to buy more Boeing planes.
Yeah.
Now Qatar's buying more Boeing planes.
Yeah.
Boeing's order backlog just is growing.
Well, the stock's up almost 30% in the last month. So certainly flowing through. I think the cherry on top was obviously the lovely gift from Qatar.
My
the 787 personal Boeing to Trump himself.
Yeah, let's
not
move
go
on
there.
from
Let's not go there.
Let's come back to Australia because in multiple sectors of the Australian economy, it appears that price wars are brewing.
That's right, Ren. The first one is mortgage wars. CanStar's Data Insights Director Sally Tyndall says more than 24 lenders have cut their fixed rates in the past month. CBA cutting their variable rate to 5.84. I'm
going to say mortgage wars have been called before.
all the time.
Mortgage wars get clicks. Mortgage wars get clicks like stock market bloodbaths get clicks.
Yeah, it's also rates of
Yeah, rates are falling. Banks are getting ahead
Banks
of the
are cutting
curve.
rates.
Yeah. NAB has predicted 6 rate cuts in the next 12 months.
Westpac locked it in.
Yeah.
I mean, the thing here is like great time to refinance or look around.
Yeah.
So that's for sure if you already have a mortgage. But yes, you're right. Mortgage wars is a very common news headline.
For me, mortgage wars give a sense of irrationality. It's when like the banks go so aggressive on pricing that it starts to erode their margin, which maybe some would argue isn't irrational. They are plenty profitable. But when banks are just getting ahead of a rate cut, I'm not sure we're quite in mortgage wars territory.
Well, CBA cutting variable, I don't know to what degree they're 5.8, but when I did a refinance, it was down to 5.81. So nothing crazy from CBA.
You must just be a good
and that's
customer.
ANZ. That's ANZ, another big five.
What are you talking about? Did you refinance with ANZ or CBA?
ANZ, but what I'm saying is like that's not that crazy cut if there's numbers out there that are already lower.
And Big Five? Are we grouping Macquarie in now?
Yeah,
Okay.
absolutely. No, it's the Bank of Mum and Dad is the fifth.
Okay.
Anyway, let's keep moving. The second price war, Ren, is happening between our two big retailers, Woolies and Coles.
Yeah, and the context for this is Coles is kicking Woolworths' ass. In the past 12 months, Coles' share price up 37%.
Yeah.
Past 12 months for Woolworths, up 6%.
Yes, I mean,
Woolworths' share price is growing slower than their raising prices in store.
I mean, you can't deny that. Woolies have announced a price cut on 400 items. They said they can save, well, they've now saved $15 on a $150 shop. So effectively a 10% saving across the board. Coles then followed 2 days later. 680 items had prices cut with an average saving of 21%.
Yeah, an average saving for the basket of 21%.
Basket, yeah.
Coles cutting more, cutting deeper, doing more for the Australian shopper.
Down, prices are down, and so is their revenue.
The irony is that, I obviously worked at Coles, you obviously worked at Woolies. We get in these bits of content where we defend the supermarkets, but most people, most of the time, don't like either of the supermarkets.
That's right.
We're
Aldi all the way.
We're pushing a stone uphill when we're trying to defend either of them. Well, Bryce, the banks may be cutting prices, supermarkets may be cutting prices, but one Australian company that isn't cutting prices is Xero.
Yeah.
They reported their quarterly numbers, and depending on which numbers you look at, it was either a really great story or an okay story.
And just to, I guess, get anyone up to speed who's just joined, Xero is a software as a service accounting business. We use it here at Equity Mates. Yes. Many small to medium-sized businesses use it as their accounting software.
Very sticky product. Once you've got all your business's numbers into Xero, once you've got company financials there, historical financials there, very hard to then extricate yourself and go to a competitor, an MYOB or Intuit QuickBooks. But look, they're pushing into the story now for Xero is beyond Australia and New Zealand. They're trying to push globally. And the focus is on particularly in the US and what they can do there. So to give you just some high level numbers, revenue is up 23%. Love to see that.
Yep.
Net profit after tax up 30%. Love to see that. ARPU, which is average revenue per user. So that's a key metric for software as a service businesses. Mm-hmm. If I just run through the major geographies, ARPU in Australia up 12%, New Zealand up 6%, the UK up 16%, North America up 27%, the rest of the world up 16%.
Nice.
Pretty good.
Solid, yeah.
A lot to like.
Yeah.
But I said it was a mixed bag because overall, net, they added 254,000 users in FY25.
Okay.
That's good.
Yeah.
But there's
Okay.
a wrinkle because I said that the story is really focused on North America
No growth.
and average revenue per user was up. So the users that stayed, they made
Yes.
more money from.
Okay.
But net, they lost 22,000 users in the US.
Really?
So that is a watch
That
for
is a watch.
the American expansion
Yeah.
story.
I mean, as we've seen, a lot of Australian businesses do struggle globally, but not a lot, but sometimes. So we will keep an eye on that.
To be fair, they added 76,000 in the UK. They added 11,000 in the rest of the world.
Okay,
So,
very cool.
you know, pretty decent report. But
Nice. Well,
Yeah.
one thing while reading through it, Ren, what I love about Equity Mates is the continued journey of learning.
Yes.
And there was a line in here. It says, the company reaffirmed its aspiration to double the size of its business. Love that. But also to maintain Rule of 40 or greater performance over time.
nice. Well, you're going to have to explain what the rule of
Yeah,
40
well,
is.
I hadn't heard of Rule of 40 before. It is a financial metric used in SaaS businesses to assess company performance. It's the combined revenue growth rate and EBITDA, or earnings before depreciation and tax, and margin, EBITDA
Yeah,
margin.
It can just be profit margin as well.
Profit margin, combining those two to be 40% or higher.
Yeah, so
I think an indication of effectively profitability and growth.
Yes, because what you don't want is a SaaS business that is growing revenue at 40% a year, but isn't profitable. Like
profitable,
the growth isn't profitable. It's spending too much to acquire customers or retain them. And then you also don't want a SaaS business that is like highly profitable and not growing. Well,
Yeah.
you might want that, but you're investing in that for
Then
dividends or
exactly,
something else.
exactly.
Yeah. So earlier I said that their revenue grew at 23%.
Yep.
So complete the equation for us.
Well, the rule of 40 for them is 44% at the moment, so that would mean their margin is 21%.
Okay, so they're above it.
They are
Nice,
44%.
nice.
Yes.
A lot to like about Xero. The one thing you got to keep in mind is that they are trading at 131 times price to earnings.
Oofed.
Compare that to Google at 17.
Yes.
All right, well, Bryce, one last thing we want to cover off in this segment. You asked the question earlier, can someone turn up the difficulty on this market?
Yeah. Yeah, can someone please? Nah, this is just, I guess some of the stocks that we've spoken about on the show over the past few months, Ren, that are in our portfolios, that we're keeping an eye on, we're loving because they're doing well.
Yes.
And
So one we spoke about a couple of weeks ago was your Transmedics.
TMDX.
Yeah, which is up more than 30% or something since you spoke about it.
Yep.
And then another one, Coinbase, which is up 50% in the past month, 49% in the past month. Mr. Beat Up spoke about Coinbase a little while ago. He actually convinced me to get into it.
Yes.
And it's up because Coinbase is now going to be the first crypto-related company that makes it into the S&P 500 index. On that day, it jumped 23%, but obviously crypto's done better. That news has helped. There's been a lot of buying activity, so up 49%. But that's not all, because another stock that I think first came to our attention from Mr. Beat Up as well was Supermicro.
That's it. Supermicro, the stock is up about 40% in the last 2 days off the back of what's going on over in the Middle East at the moment, with a lot of them signing some pretty hefty deals.
Yeah, there was a $20 billion deal signed for Supermicro
with
products.
Saudis, yeah. So, yeah, $20 billion deal for a data center operated or fueled by the
Server
products
racks,
that
yeah.
Supermicro produce. So
So
if you're not taking our stock pick seriously,
no, general advice only. But if this isn't a sell to keep listening to Equity Mates, I don't know what is.
Exactly.
Also, we should say that a little while ago now, Mr. Beat Up also said Boeing, and that has treaded water for a long time. But as you said, up 30% recently. So maybe this is a sign that Mr. Beat Up needs to come and join us.
Yeah.
But just a reminder that there's heaps of opportunity out there, always in any type of market. We're constantly going to be looking for it. And it's exciting that Well, I mean, it's exciting that a stock you own goes up 50%
exciting that
in a
we're
month.
making money. Yes, yes.
So come join us on the journey. If you, wherever you're watching, wherever you're listening, make sure you're subscribed so you don't miss any of our episodes.
This is Pimp My Portfolio. Pimp My Portfolio.
This is a segment where we get a community member to submit their portfolio for an expert to review and hopefully provide some ideas on how to improve it. And our expert in the studio today is Dawes. Adam, welcome.
Thanks so much, guys. It's great to be here.
And on the line, we have community member Kelly. Kelly, welcome.
Thank you. Great to be here.
So Kelly, before we jump into it, maybe can you just introduce yourself and tell us a little bit about what you do?
Yeah, so my name's Kelly. I'm a software developer and I've been doing that for nearly 25 years. So I guess that's why I like a lot of the kind of tech stocks.
That makes sense.
Yes, now it makes sense.
Now, well, with that segue, Ren, take us through the portfolio.
Okay, so Kelly has a portfolio that's made up of ETFs and individual stocks, but is globally focused as well. So we'll start with the ETFs. BetaShares Global Sustainability Leaders and BetaShares Asian Technology Tigers together make up a bit under 30% of the portfolio. Then we've got some US stocks. So a big holding in Amazon, 9% of the portfolio. And then Nvidia, Microsoft, and Deckers Outdoor, one I hadn't heard of before. And then when we come home to Australia, 12 stocks. We've got, I'll just read down the list in alphabetical order: BrainChip Holdings, Carnegie Clean Energy, CSL, Dicker Data, Fortescue, IGO, Mineral Resources, Novonix, REA Group, ResMed, Technology One, and then Vulcan Energy.
Nice, quite the spread.
Yeah, good spread there. So Dawsy,
Yeah.
do you have a nickname for this portfolio?
Well, this is an ethically technology-built portfolio. Kelly, is that fair to say? You've got some ethical investments in there, but lots of tech also, yeah?
Yeah, that's pretty spot on, I think.
Nice.
Okay, well, how did the portfolio come to be, Kelly? Give us a bit of a sense of how it's changed over time.
Okay, so originally I first started investing just before the GFC, so things didn't go too well there, but I was working for a stock market research company rebuilding their software, so that's how I got interested.
Nice.
Like you said with the ETFs, they kind of came about later as I was trying to get a bit of global exposure, and I just like Ethy because it was global and also sustainable.
Mm-hmm. Well, yeah, certainly some of that ethical stuff in there, and I mean, if you do sort of lift the lid on that Ethy one, you can certainly see that potentially there's not a lot of sustainability in there. They've got Apple, they've got, and you need the performance, so it's actually done quite well for you. Ethical is certainly a great way. The market potentially has moved on a little bit from the green ethical space, and sort of with Trump, in power at the moment, it's all sort of hit the back burner a little bit. But that doesn't mean that I think investors should change the way they invest just because one guy's in the office and he'll be gone in a couple of years anyway. So that's the first thing. With the Amazon one, you've had that for a long time. Is that fair to say?
Yeah, it is. I just really like Amazon because they're just real leaders in the cloud space. So
Okay,
that's
so
the kind of main reason for liking them.
It's for AWS, not for the shop Amazon.
Pretty much.
Okay, cool.
Yeah, I kind of ignore that.
Yeah, because I'm a little bit worried about supply chain issues in the US at the moment. Now the deal has been brokered the last couple of days for China to have that sort of monitor or the reprieve for 90 days. But most of Amazon's products potentially are coming from China anyway. So just be a little bit careful on that Amazon. It's probably going to be a little bit softer. Not this quarter because there's been lots of forward earnings going through, or lots of stacking of shelves. It'll be sort of in the next next coming couple of quarters. It's going to be a little bit softer. So I'd just be a little bit careful on that one. But if you're in there for the AWS side of things, well then you know what you're doing, and I think that's fantastic as well. Just talk me through some of those smaller ones, the Carnegie Clean Energy. Where did that one come from?
So I've actually had that one for a long, long time, since like 2016 or something, and I just really like what they do.
Yep.
but they just keep going down. So I keep holding on. I just think, I still like every time I go to sell them thinking, oh, look, I've just, I got to cut my losses. Every time I start looking at them again, I'm like, oh, but they're a really nice company and I like what they do and they sound like they've got a plan now. And so I guess that's probably my biggest struggle is when do I sell when things not, how do I decide when something has broken my thesis, I guess.
Well, yeah, I mean, you're right, and it's really tough. Like when people bring portfolios to me, I'm not emotionally attached to anything, and so I'm able to look at it and go, okay,
Except making money.
Except making money. Get rid of this one. Hold this. Top this up, and so yeah, it's becoming, when you become emotionally attached. It's got a great story, the wave technology and everything that's going on with that. However, you should really get rid of it. So that's my first one. Dicker Data is a really interesting business as well. We've got the Microsoft. Is it? You can tell me a little bit more about. It's the Microsoft 10 update that we've got coming up in October. Is that correct, Kelly?
Yeah, I think so. Yeah.
Yeah. So Dicker Data will do well with that upgrade that Microsoft is putting through. Obviously, Dicker Data sells computers, hardware, and then puts it through. The only thing about Dicker Data, it is mainly owned by the directors. And so there's a lot of there's not a lot of volume, or not a lot of free shares that are going on at the moment. But it has done very well for you, I suspect, over time on that one as well. And the IGO one, obviously, the lithium story is probably more of a 2026 story. Are you underwater on that one, or you're okay?
No, I'm under.
Yeah.
I think I was tossing it again. It's one of those ones where I'm like, I think in the long term it'll be okay, but it's like, how long do you write it down while you're waiting for long term?
Yeah.
Dawes, I reckon people's ears would have picked up at you saying lithium is a 2026 story.
Yes.
Can you explain what you mean there?
Okay, so basically supply and demand, right? And like rare earths, lithium's not really that rare. There's lots of it out there, right? But the demand is still there as far as batteries, the technology, everything moving forward, right? So what companies have been doing, they've been shuttering mines, they've been taking supply out of the market. The demand is still there, so the supply and demand curve says demand is still moving higher. And if once they curtail supply to get down to a level, it should then start to move with that as well. So 2026 story, letting that supply coming out of the market, it should start to form a base on the lithium price, and then it should start to move from there.
So are you buying lithium stocks towards the end of the year?
Well, we saw Min Resources and we saw lithium's catch a bid yesterday. I know this is probably going to go out a little bit later, but there is starting to get some bids starting to come in for some of those lithium. Core Lithium yesterday up 25%. There's a couple of bids starting to come through. Linetown, those kinds of things. So some of those smaller ones are starting to run. I wouldn't be buying just yet. We're not even halfway through the year, but I certainly think if you've got it, you should probably hold on to it for that 2026 story. I might be a little bit wrong on the dates, but that should start to move forward. So happy to hold it. Min Resources is probably one of the ones, Kelly, that I'd probably get rid of. There's lots of stuff that's not just about the iron ore price and lithium. It's also about the directors in there as well. So that one I suspect you're underwater on as well, correct?
Yes.
Yep.
Yeah,
Okay.
just a little bit though compared to IGO.
Yeah.
Kelly, how active are you with this portfolio? I think one of the big emissions from what I'm seeing is like a one or two just index-based ETFs. It's obviously looks to be, this is more of a REN portfolio with a lot of individual stocks.
Yeah, the price is saying it's,
Yeah,
okay.
which nothing wrong with, but I'm just wondering how actively you are buying and selling.
Look, I'm not buying and selling a lot. It's probably a couple of times a year, but I am actively looking at it and actively thinking about it. So I run a meetup for women, teaching them how to invest.
Oh, nice.
And or basically me hosting it, and I learn how to invest. So I am actively looking at the market and keeping an eye on things. But yeah, just there's when things are on the down, when to hold and when to ride it is probably the big question.
Wow, love
That's
that.
awesome, yeah.
So, Dawesy, we've covered off a number of sort of the individual stock holdings, but if we just take a step back and look at portfolio construction, do you have any thoughts on, I guess, the weightings between ETFs and individual stocks, or between US and Australia, and then just like the number of stocks as well?
Yeah, so you said about 30% was in the ETFs.
Yeah.
So I think that's okay. You've certainly gone for that more that technology side of things. I'd definitely be looking at potentially putting some index in there if you're not an active trader. So something like an IVV in the S&P 500 or a world index. So I think something like that would be good to sort of complement what you've got. I think the number of stocks are okay. Generally, we like a portfolio of sort of 15 to 20 stocks, and you're sort of pretty much in that range there as well. So I think that's manageable. It's good that you've got some direct US stocks. Okay, so a little bit you got to worry about the currency a little bit, but that's okay. But overall, I think it probably you could branch out a little bit, or get rid of something like a Min Resources and buy some BHP, kind of, that kind of scenario where you'd stick more to the quality. And I'm always about sticking to the quality. I think everybody tries to get the smaller stuff or whatever, but I think you've got some amazing quality in the Amazon, the Microsoft, and the Nvidia, that kind of stuff. So I think that's really good. So I think overall the portfolio construction is actually quite good. You could probably just tweak it a little bit to get some more growth, or at least some index weighting in there to keep performing with the market.
Nice. Well, that's good. Kelly,
Cut your losses.
did you have any final questions for Dawesy while you've got him?
No, this was really good. A few things to think about. Thank you.
Nice.
No, that's all right. Well,
yeah, Kelly, if you want to reach out to me, I can definitely help you with your little group that you've got. Maybe send some research over or something like that. So reach out to me afterwards. It'd be great to catch up.
Oh, that'd be awesome. Thank you.
Nice. Well, Kelly, thank you so much. I hope there's a few things there to think about. Don't hold on to those stocks just because you're emotionally attached to them, I think is a theme that comes through all of the Pimp My Portfolios that we do. So always an opportunity to put that money elsewhere. But thank you so much, Kelly. We really appreciate it.
No worries. Thank you.
And Adam, thank you so much.
Yeah, thank you.
Now, you run a professional portfolio review
Yes.
for the Equity Mates community. If you would like to have a portfolio health check with Adam, you'll get a personalised investment review. It's aligned with your goals and your risk profile, and you'll get a tailored statement of advice for your portfolio. $825. Head to equitymates.com/advice, and there'll be information there. If you'd also like to submit to Pimp My Portfolio, head to equitymates.com/contact, and there is a form to fill out. But Adam, thank you so much.
Yeah, thank you.
Let's ask the community.
Hey, Equity
Hi, I
Mate.
just had a question.
Hey, Bryce, I've got a question.
Questions.
Given that we are hearing more and more about rate cuts, it has got us thinking about which investments stand to benefit. And Ren, today we're going to cover this with a question from David.
that's right. I mean, the context here is that as we release this episode, the RBA are meeting.
Yep.
They meet on the 19th and the 20th of May, and then on the 20th of May in the afternoon, we'll get the results of that meeting. Widely expected to be an interest rate cut. I think Westpac officially locked it in.
Yes.
I don't think they cut their mortgage rate.
No, I
that
know
would.
what they are.
But every major bank is predicting rate cuts. I think most of the major banks are predicting multiple rate cuts. NAB said 6 rate cuts in the next 12 months. They're going
Hard.
hard.
Yeah.
Some may say too hard.
Yeah.
But look, the market's pricing in an almost certainty of rate cuts. So it's got us thinking about what benefits.
Yeah.
And we've spoken about some of the things that benefit. Growth stocks benefit because discount rates and valuations come down and debt becomes cheaper. Property benefits because people can borrow more and spend more, but also because rental yields on property become more attractive relative to other investment opportunities. The Aussie dollar falls and potentially, and that then has some implications. But we're not alone in thinking what investments will benefit, and that led to this question from David.
Hey boys, could you explain if there is any benefit in buying IHVV versus IVV based on the value of the Australian dollar? With the Australian dollar being historically below average at the moment, less than 75 cents USD, I assume there is a benefit in buying the hedged IHVV if the Australian dollar is above historical average, is there a benefit in just buying the IVV and then selling down when the Australian dollar drops? Would love to hear your thoughts on this. Thanks, boys.
Love it. Well, thank you so much to David. Great question. We love hearing from you guys. So if you would like to ask a question just like David, there'll be a link in the show notes to leave us a voicemail. So we'll start with a quick recap. IVV is the unhedged version of the iShares S&P 500. This means that you are exposed to movements in the US and AUD exchange rate. So if the Aussie dollar falls, your investment is worth more in Australian dollars. And if the Aussie dollar rises, your investment is worth less in Australian dollars.
And then on the other side, we have IHVV, which is hedged to the Australian dollar. So it removes the impact of currency movements on your investment returns. You get the returns of the S&P 500 in local currency terms. And what happens with the Aussie dollar, what happens with the US dollar will, in theory, won't influence your returns.
Yes.
If they've done a good job hedging.
Yes, true, very true.
Which they do.
Yes.
Yeah.
So then the second part of the question is, how does the value of the Aussie dollar play into all of this? And this comes down to, I guess, your view on what's going to happen with the Aussie dollar.
Yes. So let's just from a theoretical point of view, and then we'll talk about current times. So if you believe the Aussie dollar is undervalued and will rise in the future, you might prefer IHVV. That's because you don't want your returns being eaten away as the Aussie dollar gets back to normal and rises, if you think it's undervalued. On the flip side, if you think the Aussie dollar is overvalued and could fall in the future, IVV may be better because a falling Aussie dollar will boost your returns and you then get like the double kick of the S&P 500's returns and then the falling Aussie dollar.
Yes.
So that's the theory around hedged v unhedged, but let's put it into practice. Let's talk about that as David's question as an investing approach of like swapping between the two. And then, in this current moment, how we would think about it.
So I think the first thing to consider is that what you're doing is really not only having to make a decision on the S&P 500 as an investment, but you're also having to take into consideration speculating on the currency and making a decision there. So it's like a two-pronged approach that you have to be thinking about. You're not just investing in the S&P, you have to have a view on where you think currency is going to go. And currency has so many things that impact it.
Yeah. So it can work.
Yeah.
It can work, but it adds risk, and it relies on your ability to time currency movements. And let's be honest, professional investors struggle with nailing currency movements a lot of time. Because as you said, there's heaps of factors that go into it. And a classic example that could play out today is the Reserve Bank cuts rates. And in all things being equal, you'd think a rate cut in Australia leads to the currency getting weaker as global investors sell Aussie assets and move their money overseas in search of a better return.
Yep.
But at the same time, we've got this US-China trade war brewing. China's trying to stimulate their economy. China could have a massive stimulus package that then sees a lot more Aussie minerals, a lot more Aussie agricultural exports being bought by China. And that means that Chinese buyers are buying Aussie dollars to buy those products. And so potentially that Chinese stimulus could outweigh the effect of the rate cut on the Aussie dollar. So there are so many factors that go into the currency movements. And so for me, I don't want to speculate on currency for that reason, because things never just happen in isolation.
Yeah.
And then I think the other thing to think about is just your transaction costs. If you're trying to flick between IHVV and IVV, if you're with a Beta Shares Direct and there's no cost, obviously that's less important, the transaction cost, but you still got admin and tax and just the headache of trying to time the market. I don't love it.
Yeah.
If I'm gonna be perfectly blunt, I don't think it gives you a big enough boost in your returns to be worth it.
Yes, I tend to agree. I think at the dollar, if you're an institutional investor and whatnot, they obviously take it into consideration. But I think if you just want a core set and forget, this takes it out of a set and forget approach. I also think if you want to trade currency, have your core portfolio and then have a bit of money to trade currency over there. And, you can make a lot and lose a lot of money trading currency, but keep that over there. Keep your core portfolio, keep them separate. It's like people that try and invest for growth and income at the same time. Yeah.
investing is a lot simpler and a lot more effective when you have like a clear goal and you know which assets are chasing that goal, and then you're getting the best assets to chase that goal.
Yeah.
It becomes a lot harder when you're trying to chase multiple goals.
That's it.
Yeah.
Well, thank you so much for the question, David. We loved hearing from you. As I said, we love hearing from all of the Equity Mates community members. There'll be a link in the show notes or the description below if you're watching us on YouTube. And you can leave us a voicemail, or you can write to us at equitymates.com/contact, and we'll get your question on the show. But Ran, that brings us to the end. Always great to chat stocks. If you take a lot of value out of what we do, we would really appreciate it if you could take 30 seconds to just leave us a rating and a review. Leave us a comment in the YouTube section. Subscribe to us if you're watching or if you're listening so you don't miss an episode. Anything else we should add in there, Ren?
TikTok. Come join us on TikTok. It's C. Bryce lip syncing to Warren Buffett's last annual shareholder meeting.
5 hours.
Yeah, but look, wherever you are, we try and be there. So follow us wherever you're watching or listening, wherever you hang out online. We'll see you there.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.